A new and now big player in the marketplace. And the moderator is Victor Warney of SIBO. Victor, it's all yours.
Hey everyone. Victor Warney, Director, North American Exchange Traded Products at SIBO Global Markets. At SIBO, we operate 26 markets and exchanges across the globe, 5 of those being listing venues, 1 here in the United States, Canada, the UK, Netherlands, and Australia. Across those 5 venues, we list about 1,000 ETFs from 125 plus asset managers. I'll turn it over to the panelists for a brief background on themselves and their firms.
Hi, my name is Charles Champagne. I head up ETF strategy for Allianz Investment Management. We have a suite of buffered ETFs, and in my capacity, I kind of look at a lot of the product strategy, the marketing strategy, and as well as the capital markets functions for our ETFs.
Hey everybody, my name is Burke Ashenden with Innovator ETFs, Director of Capital Markets there. Innovator is the largest offer of defined outcome ETFs. We launched the first fund back in 2018.
Karan Sood, I'm with the SIBO West. My presence here is due to the generous courtesy of our partners, First Trust, for whom we manage upwards of about 50 target outcome ETFs, which is a mix of target buffer ETFs and target income ETFs.
Hey everyone, good afternoon. Jay Jacobs with BlackRock. I oversee our thematic active equity and alternative ETFs. We currently have 6 products in our outcome-oriented suite.
Awesome, thanks everyone. So we'll first start off in the simplest of terms. I know a lot of people have heard the word defined outcome, but many people also refer to these ETFs as structured outcome, target outcome, buffered outcome. For each of the panelists, in the most simplest of terms, could you please define what this type of ETF is?
And kick us off. So I guess if we had to really simplify it, defined outcome ETFs were the first ETFs that allowed you to know your full potential at the onset of investment. So before you actually clicked buy in your account, you knew what kind of downside protection you were going to have, you knew what your upside cap is. And these defined outcome ETFs, as I said, started in 2018 with what are called buffer ETFs. So if we start with buffer ETFs, which is where defined outcome ETFs started, there's really 3 terms that you need to know. It's your upside cap, it's your downside buffer, and it's your outcome period. So a typical buffer ETF, got me? Yeah. A typical buffer ETF has a 1-year outcome period. So we'll take one of our tickers is PNOV, PNOV, 15% buffer against the S&P 500 over a 1-year outcome period. So you buy that on day 1. If you hold it for 12 months, you're buffered from 0 to negative 15% on SPY, and you have an upside cap of about 15% right now. So you're 1-to-1 on the upside, and you have a 15% buffer on the downside. If the S&P goes above 15%, you don't capture that upside. If the S&P finishes negative 17 on a 15 buffer, you're down 2%. So that's the really simple way of thinking about buffer ETFs. Everyone has a different definition here on stage, I think. You hear structured outcome, defined outcome. It started with buffers, and we're seeing defined outcome ETFs grow into income and other sorts of products we'll talk about later.
Yeah, I think if we had to describe what our company does, we would use that phrase where we do defined outcome investing, or as we like to call it, target outcome investing. That's all we do, and we've been at it since 2012, so we've been staying busy. I think all of us are looking to provide better risk-adjusted returns to investors, but acknowledged in the need for something like target outcome investing is that there is utility in investments just beyond risk and return. And in this case, that utility is in deriving more certainty out of your investments. And so we take that certainty, or at least hitting the targets that we set out, as Brooks said, they're defined, really seriously. So that's entrenched in the design of the product. As a simple example, you can construct a lot of these buffer-like products with just standardized listed options that trade on the SIBO. But we choose to design these products with flex options because we are looking to really articulate to very high precision what that downside level of buffer is. And same thing in execution, right? We really obsess from a target outcome perspective we measure our success, whether we've actually hit those predefined outcomes that Brooke was referring to. And so keep a track record of this. And so we believe that this certainty of delivering targetedness in your investments has a certain utility, and that's what it's all about.
Yeah, we really look at it from the perspective of achieving outcomes. So outcome-oriented investing is really starting with what is the job to be done? What is the advisor trying to achieve for their client? And by and large, it's grow my assets, protect my assets, or generate income from my assets. And so our outcome-oriented ETFs really try to jump to the finish line there. How can we use different strategies to help achieve one or several of those goals simultaneously? So our buffer strategies are really focused on how do we protect your assets using an option strategy. Buy right strategies, how do we maximize that yield? And we have actively managed strategies like our Bali ETF, which help really combine income and growth together. But it's really starting from that perspective of what is the goal here? What are we trying to achieve, and how can we get you closer to that goal with this product?
Yeah, and to even simplify it a little bit more, it adds a little bit of certainty into what you're doing with your investments or your portfolio, right? So there's a lot of uncertainty in the market, but this really kind of the defined outcome products help gauge where you might end up at the end of a period, right? So if you hold it from day one to the final day of the outcome period, you have some of those unknowns known ahead of time and throughout the inter period of the ETF, the performance of the ETF. So, you might not know if the S&P is going to go up or down, or which, by how much, but there are some parameters on that ETF that will keep you within your risk tolerance.
Thanks, everyone. And overall in this space today, there's over 200 of these ETFs listed. They account for roughly $35 billion in assets under management, with an average expense ratio of 81 basis points and consolidated average daily volume of roughly 35,000 shares. So as the team mentioned, these products have been in place since 2018. They've grown quite a bit. They're continuing to grow. And with that, I turned to the panelists and asked, who are the primary users of these products and why?
Yeah, I could start from my point of view. So, we see these products being adopted both institutionally and retail, so heavily used in the broker-dealer space as well as the RIA space. But it goes beyond that to different age demographics, right? So we see a lot of older investors that are nearing retirement like these products because it helps them manage their risk levels a little bit easier. And then we also see it on the other side too with some of the younger investors that may not have a risk tolerance that other generations have, and they don't want to go fully long onto an equity product, so they want to have some risk management into their portfolio. Allianz is primarily an insurance company, so we look at age demographics quite frequently on the insurance side of the business, and we do these surveys, and what we find is my generation personally, but millennials, we have a lower risk tolerance than Gen X and Boomers, and so we're starting to see that, and just some of the investment trends that we're seeing with our products. But even beyond that, these products are very useful to anyone that may not have a clear or a very bullish or bearish stance on the market. They just want to have an element of risk protection or risk management into their portfolio, and this does that, and it allows them to also continue with their equity exposure. And then going back to the survey, 77% of people right now that it's 1,000 people, so it's not a ton of people, but 77% of our survey responders are sitting on more cash than they usually do. And one thing that I speak to clients about a lot right now is where cash levels are, where money market levels are, and where high yield savings accounts are being utilized. This is a good product, could be a good product to get back into the equity markets, right? So you're not taking on all of the risk that you might receive in the equity markets, but you still have that equity exposure. So you have some protections on the downside, but if the equity market starts to move up again, and you're still participating in that positive return.
Yeah, I would just say when we first launched, the structured note world was something that we thought we were disrupting. And the structured note space is gigantic. Like it's a drop in the bucket where we are right now relative to the size of the structured note space. Our ETFs primarily are used by RIAs. We're seeing a lot of independent advisors. That being said, institutional interest is definitely growing. Model portfolios are a big part of that. From our perspective, when we launched, like I said before, structured notes is what we looked at. We tried to take that exposure, bring it into the ETF wrapper, and we figured, folks that are using structured notes would prefer the ETF. They can scale it across their client accounts, daily liquidity, transparency, tax efficiency, all the benefits that come with the wrapper. But what we found is, and it was pretty cool, is that people just like certainty around their portfolio. They saw this, they could communicate to their end client that they had a 15% buffer, and they had a 15 or 16% upside cap, and they took a lot of solace in that. That was a really simple concept that they could just explain to their end client. So I think what we found is, outside of just like structured note users, this has become a real core portfolio tool for a lot of advisors. It's actually helped them build a lot of their businesses because they can so easily communicate to their end clients, you have this level of protection, and whatever the market does, this is not a black box risk strategy. It's going to behave as it's supposed to.
Yeah, quite like Berg said, our focus is also on the intermediary. We're talking about this because it's somewhat of a novel product structure. You said there's 200 odd ETFs on the exchange. So there's nuance and novelty and a lot of complexity to navigate up here, and we think the intermediary, the financial professional who manages money for their clients is best equipped to navigate that complexity. And so we build a lot of choice menu of these products for that intermediary. We build a lot of tools on how to use that, tactical use cases or strategic use cases. So we focus on the intermediary, and that's where we see most of our growth.
Yeah, we try to focus more on the strategic users, and I would really bucket them into two interesting use cases. One is more the financial planner who maybe doesn't necessarily measure risk as volatility, but measures risk as your chance of not achieving your financial goals. And that's where outcome investing can be really powerful. But at the other end of the spectrum, more asset allocators, this could be model managers or RIAs, we see them often use this in the alternatives bucket. These are liquid, transparent, relatively low-cost products that people can use in that alternatives bucket, and it can give you a very differentiated return stream, especially in the short term.
Yeah, and building on that, it sounds like advisor feedback has been excellent and your end client feedback has been excellent. How easy or costly is it for your end clients to kind of recreate these strategies on their own?
Yeah, so like I said, I think it comes down to the degree of precision that you want. Clearly, if you look under the hood of these strategies, there's, as an example, flex options that are embedded in these strategies, which are not like the easiest instrument to access for most advisors or most end investors. And then I'd speak to the beauty of the ETP forum, so the beauty of the ETF wrapper. You can do this in small sizes as an ETF. You get tax efficiency as an ETF. You get sort of the pooled investment vehicle experience as opposed to doing it yourself. So yeah, I think at least to the extent we've spoken to advisors, the overwhelming evidence is the value that's delivered as a single ticker solution is overwhelmingly high compared to trying to do it themselves. And then, as these strategies have evolved from, Berg said, it started out with the buffer ETFs. Now they're versions of target income ETFs, some of which we manage at single stock levels in a multi-stock basket. You're looking at doing 25,000 trades a year. So that's clearly left to the professional to do it in a pooled vehicle.
I would just add, like a little tongue-in-cheek when I say this way, but good luck if you try to do it yourself. The reason I say that is we talk with advisors who use options in their portfolios. It's a lot of work. Actually, you underestimate how much work it is. They have to manage those options positions. They have to trade those options positions when they go to expire. I mean, you almost need a person to have eyes on this stuff. So think about that before you try to do it yourself. Just a couple stats around that. If you try to mimic a buffer ETF, so a typical buffer ETF has 4 options under the hood. If you tried to go do that yourself in the marketplace, what we found is the average spread of the ETF is about 20 basis points, which is like 4 or 5 cents on a $25 product. If you went out and crossed the listed options, you pay between 80 basis points to 100 basis points of spread when you're going far out over a year. So you're going to pay 4 to 5 times just in spread. On top of that, you care about your cap, right? So we talked about buffer ETFs before. They got that buffer and they have the upside cap. Well, you want to have as high of an upside cap as possible because you want to experience all that upside. If you went out and you didn't have the economies of scale that some of these issuers have up here and you tried to do it yourself, we modeled on a 15% buffer, it would cost you about 2% of your cap. So if you have a 15% cap, you're now at a 13% cap. So again, you can do it yourself, but you lose out on the tax efficiency, you lose out in the economies of scale, and in the wrapper. That's why we're all here. The ETF is such an awesome wrapper, and it just made sense to bring these exposures into the ETF.
Yeah, I would say we really have not encountered clients who are saying, I'd rather do this myself. They're very happy to have an ETF available. If you compare it to doing yourself, it's really about efficiency. We all know and love how great ETFs can be for efficient access. But if you compare it to structured products, you also get that liquidity. You tend to get lower fees. So just as we've seen in so many different asset classes and strategies, ETFs can really be this efficient, low-cost, transparent, liquid vehicle that clients increasingly use. So just very rarely ever comes up that someone would want to do this themselves.
We know a lot of people are always concerned about market timing and what's going on in the market. Is there a specific market environment that these products are more so geared towards?
Yeah, so I look at these products as evergreen investments, right? I think every advisor, portfolio manager should have some element of risk management in their portfolio. And I think when you look at markets in general, like if you look at even the past 2 years, right, what have we seen? In 2022, stocks and bonds were in double-digit negative returns. If you held a buffered ETF as a piece of your portfolio in that year, you did pretty well. If you were down a little bit or not down at all. And then even if you look back at 2020 in March of 2020 during the COVID crisis, if you held a buffered ETF throughout those months, you would have absorbed some of that sell-off, and you would have been able to participate on the upside when the market rallied back. So these things are very useful tools throughout market regimes and market environments. But the pushback that we get is, well, what about 2021? S&P was up 30%. Well, yeah, because they are capped out depending on volatility levels, you might miss out on some of the upside. But if you actually look at it in totality in a portfolio, if you did a 60-40 portfolio in 2021 and 2022 versus a 50-30-20 with that 20% allocated to a 20 buffer ETF, you're going to underperform on 2021 by 120 basis points. You're going to outperform in 2022 by 300 basis points. So you're going to net out over that longer period just about 200 basis points of positive performance based on that risk mitigation that you've applied to your portfolio. And then even like right now, right? So if we look at stock bond correlation, they're positive right now, and largely for the last 25 years they've been negative. So when you think about diversifying your portfolio between stocks and bonds, you're not going to get that protection on your fixed income side if the equity markets start to go down again, as you would in years past. And we like to look at like correlation as a hope, right? You hope in that negative correlation is going to protect one side of your portfolio when the other side isn't doing right. This is explicit protection when you have a buffered ETF, right? Because you're going to get that protection regardless of what it is. So it's kind of a hope versus an explicit protection, in my opinion. So that's how I like to look at it, and I just think these things kind of transcend different market environments.
Yeah, I think Charles, covered the investment case so well, right? But like I alluded to earlier, it's not just about risk-adjusted returns. Although in a challenging market, these products will really shine. But also there are solutions to problems that clients have that their advisors are trying to solve for. So you could have a novice client looking at the volatile market and sitting in cash. Now here's a tool for them to get into the market with a significant degree of downside protection. Or you could have a client that's concerned about the toppish nature of the market, and they can get out of equities and lock in their gains with significant amount of protection and still participate if the market continues to rise. So I think it's the utility in this definition that leads to solutions as opposed to just evaluating the product on risk-adjusted returns, which again, it's got a phenomenal track record from that perspective. To Charles' point.
Yeah, we found that a lot of our clients felt like some of the longer duration defined outcome products almost forced you to be really cognizant of what's happening in the market. You had to really know when you're entering into the product, where the cap and the floor is, if you reach the cap or you've blown through your buffer, being able to exit that product and rotate into another one. So when we designed our product, it was really specifically trying to avoid having to think too much about where the market is and where this product is, and really make it more of a buy and hold. And so the key feature that we changed is looking at it from a quarterly perspective, not resetting annually where you can be kind of at that cap level or in your buffer level for several months, but having a product that resets quite frequently to the prevailing market conditions. This was really intended to not have to try to time the market or get too tactical, but to really see this as a long-term buy and hold risk management strategy.
Now, with rising interest and increased volatility in the market, how have those impacted your various outcome caps?
Yeah, this is a cool topic. So interest rates and volatility affect the caps you get on buffer ETFs or all defined outcome ETFs. Interest rates and volatility are higher right now, which means higher upside caps for the defined outcome buffer ETFs. We talked about COVID, we talked about 2021, 2022. Why these products, I think, have staying power and why they're so interesting is that, like we said before, they transcend market environments. And how they do that is, if you were coming out of COVID, an extremely high volatile time, and you bought a buffer ETF, the cap was extremely high. It was like in the 20s. So that's, suddenly that 15% buffer with a 20-something% cap looks pretty appealing, and you're able to actually participate in some of that V-shaped recovery that we saw. Conversely, when interest rates and volatility were a little bit lower, we saw a lot of folks use the buffer ETFs as a bond alternative because they weren't getting the yield that they were looking for in their bond sleeve. So again, the products just have so many different use cases in all market environments.
Yeah, we referenced structured notes up here. Disrupting structured notes or being inspired by structured notes. They've existed for a few decades now, and the buffer payoff in that space is really an evergreen payoff, primarily because of all the things that Bert mentioned. Not to get too technical, but there is an embedded negative vega in these structures, a negative rho in the structure, so it tends to have a countercyclical signal to the market. So when rates a vol is going up, which tends to happen when markets are going down, you get higher caps, so allowing you to participate more in the recovery. Same thing with interest rates. They do have duration to them, so they're 1 year out, or in Jay's case, they're 3 months out, and so there's a responsiveness to interest rates there. So if you have rates go up, you have more duration sensitivity in the product, and you have more to play with, so which translates to higher caps.
Now, for potential investors looking to transact in these products, what should they think about ahead of doing so? Is there a specific time that they should do so? Is there any external considerations they should have before transacting in one of these products?
Start here. So the ETFs rebalance, right? We talked about the annual outcome periods. We tend to see the most volume in these ETFs come in the day before the reset. And that's because folks want that fresh outcome period cap and that fresh downside buffer. That being said, you can allocate at any point during the outcome period for a defined outcome ETF. We talked about 1 year outcome periods earlier. Somebody could buy into a defined outcome ETF at any point during the outcome period, and they'll still have a defined outcome if they hold until the end of the outcome period. If they sell early, they're not going to have that defined outcome. That's a key thing to know. That being said, the whole point of this is that we have clients that actually come in intra-period and find cool asymmetric payoffs in the ETFs. That's sort of like level 2 defined outcome thinking. Level 1 is most of the advisors we speak with buy in on the reset period. They bring new money in. It's going into their defensive equity or bond sleeve, and they let it sit in the ETF. And they can do that, unlike a structured note, where at the end of that 1 year, that note expires. With this ETF, it rolls within the structure. You get a fresh cap and a fresh downside buffer, no taxable event, which is awesome. You can sort of hold it in perpetuity for future outcome periods.
Yeah, it was interesting what Jay said about designing the products with a shorter duration, and I believe the part of the rationale is so that you can have that defined outcome well-defined more often. If you have longer duration products, another way to get to the same place is to offer a lot of them. So you end up with a calendar of offerings where you might have some products that have 2 months to go, 1 month to go. But it's sort of going back to my earlier comment, that does create some complexity, and so that's why we think it's best for a financial professional to navigate that complexity, and we try to arm the financial professional with tools on how they can, read through these 50-odd ETFs that we offer, depending on what specific outcome they're looking for, whether it's short-term or long-term, what degree of downside protection they want, which specific market they want their downside protection on.
Awesome, and I know a lot of you offer different monthly series, fund of funds. Maybe could one of you just explain the difference between when a monthly series would make sense for someone versus a fund of fund of the monthly series ETFs?
Yeah, so I think it's funny you said level 2.
Yeah.
I mean, as this space has matured, and we've been at it since 2012, we've seen some clients who've engaged in these kind of products mature to level 3, level 4. And that's where, they'll look at all these different products and they'll start using it in ways that we didn't foresee initially. And, that's in some ways developing products that clients use in ways you didn't foresee is a really positive experience. In some ways, it's a humbling experience. You thought, this is how they should use it, and they show you how they can use it differently. And so we've responded to take a lot of those use cases and wrap those strategies as fund of funds, so we can again leverage the tax efficiency, liquidity, the ability to trade in small sizes, that all the beauty that the ETF wrapper offers. And so now you can, of course, still do it yourself, or just get the strategy package as a fund of fund.
Yeah, I would say, we offered fund of funds too. I think if you're an advisor that doesn't want to have to think about any of the monthly series, definitely fund of fund makes sense. The RIAs and the folks that we speak to are actually building some model portfolios using the buffer ETFs. What we see is sometimes they'll use the quarterlies, so they'll do like a January, April, October, et cetera, July. That's something pretty popular, but if you don't want to manage 4 to 12 tickers, you can certainly use the fund of funds. So we kind of see it run the gamut. The fund of funds certainly makes sense for an advisor that doesn't want to think about that.
Awesome, and I think that leads into the next question, Burke. Have you guys really seen a rise of these products being incorporated in model portfolios? I know distribution is an exciting part of the ETF ecosystem and one of the most important parts. So what have your distribution models been like? Have you seen a rise of these in model portfolios? How are you getting the word out about these products?
Yeah, I think it's kind of coming from 2 areas, and one I already mentioned, which is people are looking to fill the alternative sleeve with ETFs. Not every alternative strategy makes sense in an ETF. There's things that are illiquid, there's things that are private that you can't do, but liquid option strategies are things that you can do in an ETF. So in some ways, this really solves a challenge for models that want to have an alternative sleeve, but might be a little bit more limited in the ETF structure. But the second use case for models is really about differentiation. We see a lot of 60/40 models that have really done a lot to build around a low-cost core, and you're starting to see differentiation around the edges, whether that's trying to access more growth through thematic investing or alpha-seeking strategies, whether that's through income with things like buy rights or protection with buffers. But really, we're starting to see that differentiation within the model space, and I think buffers and outcome strategies fit really well into that.
Yeah, I totally agree, Jay. And I think what we say to advisors is this can differentiate your practice. We're talking with dozens of advisors who manage model portfolios. If you can create a buffer ETF model, you're different than a lot of your peers right now. And a lot of folks aren't doing it yet. We're speaking with some larger institutions. There's definitely interest out there. A lot of folks look to us. We offer paper models on our website if folks are looking for kind of a way to get started on that. But from our perspective, we think models are where the puck's going for all ETFs. We know that. But Specifically on the buffer side, we're kind of in the early innings, I would say. And once that gets going, we're really excited to see where assets go.
Yeah, I think it's just a sign of the maturization of this space or sort of wider adoption. So early on, these products were being used more tactically, and then there were some brave advisors who started using them strategically, and now it's reached a stage where in any model, you've got to make room for this unique risk-adjusted return, and especially with the backdrop of the macroeconomic environment that we see right now, right? So fixed income, which has played the traditional role of risk management, is somewhat challenged to do that. And if you continue to see rising rates, there's going to be a sort of identity crisis for fixed income. And that's where, here's a solution which brings the insurance parallels from your everyday life, right? Like there are so many risks in your everyday life, you buy just insurance and just transfer the risk to somebody else. That's, options are the insurance of capital markets. And so that appreciation for that has increased both because of these products and because of the macro environment.
Awesome. At this point, we'd like to open it up to questions. I know we have about 10 minutes left, so if there are questions from the audience, we're happy to address those right now. Steve.
So there was a question or comment made around how small this managed risk space is relative to the structured note space. I just wanted to know, sorry, I don't have a mic, I'll speak up. Just wanted to know regarding the comment made earlier about the size of the managed risk ETP space relative to the structured note space. Any comments, like maybe some more color on how big that opportunity set is? What are some other differentiated areas in the structured note space that could make their way into the ETP ecosystem?
Yeah, the structured note space is, I don't have a number off the top of my head, but it's between 10 and 100 times bigger than where we are now. So it's significantly bigger. We started with buffers, right? And you can kind of think, if we're talking structured notes, you can kind of think of buffers almost like a RILA. If you're familiar with the structured note world, it's linked to an index, it gives you the returns. What's really popular in the structured note world is also barrier income notes. So income, everyone's talking about income these days. We launched what are called barrier income defined outcome ETFs. So we started with buffers, and then we moved to barrier income. The reason we did that is we kind of look at the structured note world as our North Star when we launch new products. And we found that barrier income notes and income generating notes sell significantly more than RILAs. But buffer was kind of a concept that was more welcomed, I think safer to bring to market first. But now we're starting to see, to your point, the evolution of structured note products coming to the ETF wrapper. I think we're really in the early stages here. I think we're just scratching the surface. There's certainly a use case for structured notes. You get that specificity. It could be exotic for a particular client. But we're sitting up here. We've seen the growth of ETFs. If we're able to tackle anything like we did in the mutual fund world with ETFs on the structured note side, we're really, we're not even hitting first base yet.
Yeah, don't hate me, but I spent the better part of a decade working at a bank in the structured note business. And that market was averaging about 120 billion in annual sales leading up to 2008, and dramatically shrunk, which is why it got a bad rap to it, and we came up with a concept called Defined Outcome Investing in 2012, and we're going around the street trying to convince people that, hey, you could now do the same thing, but in a fund. So you had full transparency, and you had liquidity, and you could do this with these cool things called flex options that trade on CBOE. I would have guessed in 2012, by now we would have seen a lot more payoffs. But I think I appreciate what Jay's saying, which is there are certain payoffs or certain kinds of risk returns that are better off in other wrappers. ETF, no matter how much we love this technology, is not best suited for everything. So I think we will see more evolution of this space. I think you had a number on what's the assets in
35 billion.
35 billion, and 28 structured notes were selling 50 billion a year. So we're getting close.
Awesome. Any other questions? Great. So I know a lot of you offer different outcome caps. With your end investors today, what outcome cap is resonating the most? Are they on the higher side or closer side to maximum efficiency there?
Well, for our line, so we offer 10s and 20s on a 1 year duration, and then we offer 10s on the 6 month of the buffers. Our 20 buffer by far sells well more than our 10% buffer, and obviously, when you have a 10% buffer, you're going to have a higher cap than a 20% buffer. So, it could be a combination of things, but where we're seeing our most success, and I think it's about 75% of our assets are in our 20 buffers. They are unique. They're from the field because First Trust and Innovator don't offer the 20. However, I think it just shows that people value that protection a little bit more. At least the independent broker-dealer channel that we're primarily playing in, they value that protection over the upside ability.
I would just say caps right now. So we launched kind of in that ZERP environments, and we went back and looked at like what caps would have been in like the 80s and the 70s and going way back decades. And caps right now are elevated, but they're elevated relative to what have been traditionally low caps over the past 5 years or so. I said before we have a 15% buffer. It's got about a 15 to 16% upside cap. That's still below the long-term average of what that 15% buffer would offer you in terms of upside. Going back to, I think it was 1976 we looked at. So, I mean, that's just another tailwind, in my view, for defined outcome ETFs. As we see volatility come back and interest rates go higher, these ETFs are going to look a lot more appealing as a defensive equity, hedged equity, or even a fixed income alternative in the portfolio.
So we'll round out the panel then with what exciting innovations do you see in the defined outcome space going forward? We'll start with you, Jay.
We already hit on it. I would go back to models. I think this is really about the use case of these products. There are plenty of products on the market. There's different reference assets. There's different buffer levels. There's different roll periods, which is great. That gives a lot of choice to investors. But now I think it's implementing it in a portfolio that's going to be the big unlock. So maybe a little bit of a cop-out answer because we already talked about it. But I think models are going to be incredibly disruptive to the defined outcome space.
Carl?
Yeah, so we're all competitors up here, so we try to keep each other on our toes. So I think at this stage, sort of responding to clients' needs to see these kind of products in more with different levels of downside protection on different risk assets beyond just large cap equities. That's almost a bit of a table stake. But if you look at the wider adoption of these products, even though the space has matured somewhat, it's still, in the more independent space. So I think the wider adoption, having these available at more platforms, more broker-dealers, is probably what I would get most excited about. And I think we're all in the same boat rowing towards that. So hopefully there come a time where we don't need to do a panel like this because this is going to be such a mainstream part of investing.
Mark? Yeah, I would say I agree. I think we're still, again, in the early innings in terms of adoption. A lot of RAs, independents. We're seeing demand in some of those independent channels, independent broker-dealer channels, as well as wirehouses, but we're just not there yet. And once we get there, I think the space will grow significantly. My answer would be more on the product development side. I think, ETFs launched and everyone said, oh my gosh, there are too many ETFs. There's an ETF for everything. And then defined outcome ETFs came around and it just unlocked a whole new amount of ETFs and different ways that you could structure these products. So, we launched a cool one as TJUL. It was a 100% buffer ETF. People saw that headline and they're like, what is this? Is this a scam? Is this not real? And it's a really simple concept. It's just a buffer ETF. It gives you a 100% buffer over a 2-year outcome period with a 16% cap. So, I'm not trying to shout out tickers, but I just think that there's a lot of product development that's yet to be done, and there's a lot of interesting payoffs that advisors are going to love that's going to come out of this.
Yeah, I'm piggybacking off Burke here. I mean, I think it's a product innovation that's going to happen over the next couple of years. Again, being an insurance company, it's not easy to build an ETF business in an insurance company, let's tell you that. But the one thing we do have is we have decades of experience running these types of strategies, whether it's in a RILA wrapper or elsewhere. So we've been running option strategies for the better part of 25 years. And what you can do in that with these products and put into an ETF wrapper is going to be evolving quite often over the next couple of years, and it's going to help our clients meet their objectives, right? So, and there's so much you can do in that space, and still keep it a simple product, a simple enough product, but have different outcomes, have different types of payoffs, have different, features to them that will make them more attractive to a wider audience.
Awesome. Thank you, everyone.